Every paycheck I did the right things, yet my bank balance stayed flat, like I was running underwater. I watched friends upgrade homes, cars, vacations, and wondered why my progress felt invisible, slow, and honestly embarrassing. I wasn't reckless or lazy. I worked hard, paid bills, saved, yet still felt financially behind somehow, constantly. Then I learned a truth. Wealthy people don't live off income alone. They live off assets and loans. And once you understand that, money stops feeling like a mystery and starts looking like a real system. Wingbeats. Today I'm breaking down 3 words that explain the system. Buy, borrow, die, without hype, jargon, or shame. Before we dive in, if calm, clear money talks help you, please hit like so this reaches more people. Comment buy if you want my simple checklist for building assets from scratch, even on a normal paycheck. Comment borrow if you want the safe borrowing rules, because most people fail exactly at that step there. And if you're new here, subscribe. These videos are weekly, practical, and built for real life, not fantasies. Now, here's the uncomfortable part. Selling your winners is often what keeps you stuck for decades, quietly too. Because when you sell, you may trigger taxes, and you also break the compounding that builds real wealth. Compounding is quiet, slow, and boring until it suddenly isn't, and that's when your entire life changes fast. Buy means you own assets that tend to rise over time. Businesses, broad index funds, or real estate. You're not buying to look rich. You're buying to build a machine that works while you sleep, steadily. Kortu. Borrow means you use those assets as collateral, pulling cash out without selling the asset itself, today, safely. That sounds dangerous, and it can be, unless you keep borrowing conservative and your cash flow stays strong, always. Die is the part people whisper about. Inheritance rules can change tax outcomes through something called step-up basis. This isn't a loophole you hack. It's how the rules are written, and you deserve to understand them. In this video, I'll show why banks love this, where people get hurt, and the safe version for you. Banks love loans backed by assets because they earn interest while holding protection if a borrower fails when markets turn ugly. They don't need you rich or broke. They need you borrowing emotionally, without math, without a plan at the wrong time. So we slow down and name the real goal. Keep the asset growing while accessing cash carefully with strict limits. Imagine an index fund account worth $100,000, quietly rising year after year behind the scenes. If you sell, you may owe capital gains taxes, and your compounding restarts from a smaller base for the next decade. If you borrow instead, you don't sell the asset, so gains stay unrealized while money stays available for bills or opportunity. But borrowing isn't magic. It's a trade. You pay interest to buy time and avoid forced selling when panic hits. In 2026, prime rates have sat around the mid-6% range, reminding us debt has gravity every single month. That's why the safe version uses low leverage, big buffers, and a plan if rates jump higher next quarter. Think like a pilot. Assume turbulence, keep altitude, and never fly close to the ground financially without an escape route. Now the die part. Many estates receive a cost basis step up, changing taxes for heirs later when they sell. In 2026, the federal estate tax exemption is about $15 million, which changes who worries and who doesn't today. That's why wealthy families often hold assets for decades, borrowing modestly, letting time do the heavy lifting behind closed doors. But most people hear this and skip by, rushing straight into loans before owning anything worth lending against. That's like renting a gym membership, then attempting a world record lift on day one, alone with no spotter nearby. Koryu. The first killer mistake is overborrowing, because rising markets make you feel safe right before a drop. When assets fall, lenders can tighten terms, demand more collateral, or force sales if ratios break on paper overnight. That's how people get wiped out. They sell at the bottom, not by choice, but by contract and panic combined. So my rule is strict. Borrow only with stable income, cash reserves, and an exit plan written down. Next, I'll give you 3 rules that keep you safe when rates spike, markets fall, and fear spreads through your family. Hisiu. Rule 1 is simple. Never borrow so much that one bad month can knock you off course financially. I want your loan payment to feel boring, like a utility bill, not a cliff you stare at. A good starting guardrail is low loan to value, so your collateral can fall without triggering forced action. When people borrow near the limit, they're not building wealth. They're renting confidence from the market. Rule 2. Keep cash reserves for interest, because markets don't crash on your schedule or your birthday. Gerind, cash is not a waste. Cash is insurance that prevents you from selling your best assets at the worst time. Rule 3. Borrow for flexibility, not for lifestyle, because lifestyle debt turns freedom into a monthly prison. If you borrow to impress people, you're paying interest to perform, and that performance will eventually collapse. The rich borrow to protect compounding, not to buy toys, and that difference changes everything over time. Now I'll show you the psychological trick that keeps normal people selling early, even when they know better logically. What? It's called the cash craving, the urge to see money in your checking account because it feels safe instantly. But checking accounts don't compound like ownership does. So safety today can silently steal freedom tomorrow. When you sell a winner, you feel relief, but you also erase the future growth you can't get back. That's why the system rewards patience, because patience keeps you owning while everyone else is trading emotions for cash. I used to sell too soon, telling myself I was being responsible, while really I was afraid of volatility. If you're watching this in America, you've felt that fear, because headlines train us to panic about every dip. And when you're juggling rent, childcare, groceries, and insurance, panic feels rational, not dramatic or irrational. So let me say this clearly. This strategy starts with empathy, not arrogance, because life expenses are real. The goal is not copying billionaires. The goal is building options so one emergency doesn't break your entire future. In the next part, I'll map the safe buy path for regular people, starting with one paycheck at a time. If you're a W-2 worker, your first move isn't borrowing, it's building a base that can't collapse easily. Start by destroying high-interest debt, because nothing compounds faster than a credit card charging you every single day. Then build an emergency fund, so you stop treating investments like an ATM each time life punches you. I'm not saying save forever, I'm saying buy yourself breathing room. So decisions come from logic, not panic. Next, automate long-term investing, because consistency beats motivation, especially after work when your willpower is gone daily again. Broad index funds feel boring, and that's the advantage. Boring survives recessions, keeps fees low, and compounds quietly. If your 401k offers a match, take it first, because it's free money with an instant return today. If you have an HSA, learn it, because triple tax advantages can turn medical costs into long-term wealth. Wealthy people don't start with secret loans. They start with ownership, then defend that ownership like oxygen itself. When you own enough, borrowing becomes a choice, not a need. And that difference changes your sleep tonight. Deutsche. My personal rule is brutal. If borrowing creates anxiety, you're too close to the edge already financially today. Money is supposed to buy peace, not adrenaline, not refreshing your balance every hour like a nervous habit. Here's when banks quietly win. You confuse good debt with easy money and stop asking questions first place. Good debt is structured, boring, and backed by cash flow. It doesn't depend on hype, luck, or vibes alone. Easy money debt is loud, fast, and emotional, and it turns small mistakes into lifelong setbacks quickly for you. In 2026, rates still matter. So every extra % of interest is a monthly tax you never see. So if you borrow, keep it conservative and make sure your plan survives a 30% drop without selling. Ask yourself this: can I pay interest for 12 months if my income stalls and markets stay ugly? If the answer is no, you don't need a loan. You need reserves, patience, and more ownership first. Now I'll walk you through the simplest buy, borrow, die example, with numbers so clear you can't forget them ever. Imagine you invest $500 a month into a broad index fund, and after years, it reaches $120,000 quietly. If you sell the whole thing to pay expenses, taxes may bite, and your engine stops growing immediately. But if you borrow just 10%, $12,000, you get cash while the $120,000 keeps compounding quietly in the background. Yes, you pay interest, but your goal is to keep borrowing small enough that growth outruns cost long term. This is why I call it renting liquidity. You rent cash today so you don't sell ownership forever later. Darne. Banks love this because your loan is secured and you keep making payments, even when life gets messy. But here's the twist. The more disciplined you are, the less you borrow, and the safer you become. Most people do the opposite. They borrow more as confidence rises, right before the market reminds them who's boss. So I set a rule. Borrowing should reduce stress, not create it, and your plan must be boring. If your plan depends on perfect returns, perfect rates, and perfect timing, it isn't a plan at all. Querit. Now let's talk about the emotional reason this feels unfair. You were taught to fear debt, not use it. Meanwhile, the wealthy were taught to fear selling because selling triggers taxes, resets growth, and ends options fast. In 2026, capital gains brackets still reward patience, but only if you understand the difference between income and gains. And interest rates still punish overconfidence, which is why I keep repeating, low leverage, big buffers, slow moves. If you're raising kids, paying rent, or rebuilding after layoffs, you don't need hero moves. You need stability. So the safe version starts with buy. Automate ownership first, then borrow later only when it protects that ownership. When people ask me, Alex, is this legal? I say yes, but legality doesn't mean it's right for you. My goal isn't to make you copy billionaires. My goal is to stop you from selling your future for relief. Because one emergency shouldn't erase 10 years of progress, and the system is designed to test you there. Next, I'll show the 3 situations where borrowing can be smart, and 3 red flags where you walk away. Next, here are 3 smart times to borrow: bridging taxes, emergency liquidity, and strategic reinvestment without selling everything. Situation 1, you face a big bill, but selling would lock in taxes and destroy your compounding momentum. A small temporary loan can buy time, letting you pay the bill while your investments keep working quietly. Situation 2. You're a business owner with seasonal income, and you need smooth cash flow between peaks and valleys. Borrowing against stable assets can prevent panic decisions, like discounting your services or selling equipment in desperation today. Situation 3. You have a low-rate line and a clear opportunity, but only if you stay conservative and insured. Now, 3 red flags where you walk away. Borrowing to flex, borrowing to chase losses, borrowing without reserves. If your reason is, I deserve it, pause, because emotions are expensive, and lenders collect on them faithfully. If your plan requires the market to rise next month, you're not investing. You're gambling with borrowed time. And if you don't have a cash buffer, the loan owns you. Not the other way around ever. Here's the mindset shift. Debt isn't evil. Unmanaged debt is, and the difference is discipline plus math always. When I finally learned this, I stopped asking, can I afford it? And started asking, what will it cost? Because the hidden cost isn't the payment. It's the future growth you sacrifice when you sell your winners. That's why the rich protect ownership like a family heirloom, while the rest of us trade it for relief. If you've ever felt ashamed for being behind, I get it. But shame is a terrible financial advisor. Shame makes you hide from numbers, and hiding makes small problems grow into emergencies that steal your confidence. So my promise is simple. We face the numbers calmly, build ownership patiently, and borrow only to protect it. In the next segment, I'll explain step-up basis in plain English, and why it changes family wealth across generations. But first, I need you to hear this. You don't need a fortune to start this process today. You need consistency, a simple plan, and the courage to stop comparing your Chapter 2 to someone's Chapter 20. Alright, now let's demystify step-up basis. Because this single rule quietly explains why some families rarely sell assets ever. If someone buys stock at $20 and it's worth $200 when they die, that gain changes for taxes. In many cases, heirs receive a new cost basis near market value, so selling later can mean less tax. That's not a secret loophole, it's written into law, and it's one reason wealth sticks around longer generationally. But here's the line people miss. You don't get step-up benefits if you're forced to sell early today. So the real game is resilience, building cash buffers and low leverage so you can hold through storms calmly. When markets drop, the wealthy ask, how do I avoid selling? Most people ask, how do I survive? I'm not judging that second question. Rent, childcare, and medical bills make survival a real daily fight too. That's why my version starts smaller. Build a simple asset engine, then add borrowing only as protection later. If you're investing $200 a week, you're already playing the buy part. Don't let impatience break it now. The bank wants your impatience, because impatience creates fees, penalties, and desperate loans you accept without reading terms. So here's a memorable rule. Borrow to protect ownership. Never borrow to pretend you have it already today. If you want one metric, track your loan to value like a speedometer, and keep it far from redline always. And track your cash runway. How many months you can pay interest without touching investments when life hits hard. Because the nightmare isn't paying interest. The nightmare is selling great assets in a panic on a Tuesday. Iat traído. Now let's connect it back. Buy builds the engine. Borrow buys time, and die can soften taxes later. But none of it matters if you skip the boring basics. So I'm giving you a quick action plan. Tonight, list your high-interest debts, your emergency fund target, and your automatic investing amount. No judgment, just truth only. This week, raise your ownership rate by 1% and lower your lifestyle debt by 1% too. And if you want the next video, comment buy, borrow, or die, and tell me your biggest fear. Let's make this practical with a weekly checklist, because clarity beats motivation when life gets loud and unpredictable. Step 1. Automate ownership first, even if it's small, because small ownership compounds into big confidence over time. Step 2. Build your buffer, because your emergency fund is what keeps you from selling at the worst moment. Step 3. Reduce toxic debt, because high interest payments are a silent wealth tax you can actually control. Step 4. Increase your skill income, because a stronger paycheck makes the buy phase faster and less stressful. Step 5. Only consider borrowing when you have reserves, stable cash flow, and a conservative loan-to-value plan. If you're thinking, Alex, I'm behind, I hear you. But behind is not a permanent identity. Behind just means your system needs a reset, and today is a better day to reset than next year. I've seen people transform by changing one habit. Stop selling winners. Stop financing lifestyles. Start owning patiently. And I've seen people collapse by copying the rich incorrectly. Leverage too high. Buffers too thin. Ego too loud. So here's my honest opinion. Most people don't need smarter tricks. They need fewer mistakes repeated every month. The banks aren't villains, but they profit when you treat debt as a personality, not a calculated tool. Your advantage is understanding, because once you see the system, you stop playing it like a casino. And when you stop playing emotionally, you start building quietly. And quiet building is how wealth actually grows. If this video made you feel calmer, that's the point. Because calm people make better money decisions. So take one action today. Automate a small buy, cancel one useless subscription, and move that money into ownership. Then take one action this week. Grow your cash buffer by 1 day of expenses, just 1 day. Then take one action this month. Reduce one high-interest balance, even if it's only $50 at first. Those tiny moves feel unimpressive, but they create momentum, and momentum is what breaks the stuck feeling. Next, I'll give you the final warning and the final encouragement, so you leave with confidence, not confusion. Final warning. If you borrow without a buffer, you're building a house on sand, and storms always come. Final warning, if you borrow to chase returns, You're gambling with leverage, and leverage punishes pride fast. Final warning. If you borrow to impress people, you'll pay interest to perform, and performance is exhausting forever. Now the encouragement. You don't need to be rich to start, you need a plan you can repeat. The most powerful financial moment is when you stop comparing and start stacking small ownership in silence daily. Because every dollar you own becomes a worker for you, and workers don't complain when you're tired. So remember the 3 words, but remember the order even more. Buy first, borrow later, die eventually. If you take nothing else, take this. Selling your best assets too early is the expensive mistake most people repeat. And if you want to break that pattern, build buffers, stay boring, and protect compounding like your future depends on it. If you want my checklist, comment buy and I'll pin it. If you want borrowing rules, comment borrow below. If you want the inheritance basics explained simply, comment DIE, and I'll make a follow-up with clear examples. And if you know someone quietly stressed about money, share this video, because shame grows in silence. Before you go, hit like so YouTube shows this to people who need calm clarity, not loud financial drama. Subscribe if you want weekly money clarity, and tell me where you're watching from in the comments today. I read those comments, and they help me make videos that actually match real life, not perfect spreadsheets. Thank you for spending time with me. And remember, the goal isn't looking rich, it's staying free. Your next paycheck is not just money, it's a choice point, and small choices repeated become your identity. Start with one small buy, protect it, and let time work. That's the quiet path most people miss. I'm Alex, and I'll see you in the next video, where we go even deeper into safe borrowing rules. Until then, stay calm, stay consistent, and keep building ownership, because ownership is what changes everything over time. One last thing. Write down your net worth today, not to judge yourself, but to see direction clearly. If it's negative, you're not broken. You're simply in the build phase, and that's normal for many Americans. Track one ratio monthly. How much you own versus how much you owe, and keep improving it steadily. When you feel tempted to sell, pause and ask, am I solving a problem or buying relief today? Relief is expensive if it steals your compounding, so build buffers that let you wait for better timing. If you're overwhelmed, start with a 15-minute money date each Sunday and keep it gentle for yourself always. I'll pin a simple starter checklist in the comments so you can take action without overthinking everything tonight. And if you want the advanced version, I'll break down HELOCs and securities-backed loans in plain English next. But I'll also show the dangers, like margin calls, rising rates, and why safe can turn unsafe fast. Because the point of knowledge isn't to feel superior. It's to protect your family from mistakes that hurt. If this video helped, send it to one friend who thinks debt is always bad. No exceptions ever. And if you disagree with me, tell me respectfully. Those conversations make this channel smarter, not louder for everyone. Remember, I'm not your financial advisor. I'm your calm friend translating the system so you can decide wisely. If you want sources, I'll list the IRS and Federal Reserve links in the description for you too. The goal is simple. Own more every year, owe less over time, and never let panic drive decisions. Buy is your foundation, borrow is your tool, and die is the rule that explains generational outcomes often. If you only do one thing after watching, automate a small investment and raise it by 1% monthly. Then, build your buffer until emergencies become inconveniences, not catastrophes, and you stop selling your future in panic. Next week, we'll go deeper on safe borrowing rules with real examples so you can borrow without fear. Until then, stay consistent, stay humble, and keep buying assets, because that's the strategy banks secretly respect most today.